Wits University in its virtual format. I see that we have about 143 attendees. So Governor, I must say you're very, very popular, and that you can pull out a crowd on a virtual format of Wits University. I do want to thank you, Governor, for making yourself available. It's a real pleasure to have you at Wits, and it's a real pleasure to have you speak on the question of COVID-19 and monetary policy. I was asked to make a few introductory comments, and I thought that what I should do is just highlight for our audience the three fundamental ways in which I think COVID-19 is going to impact on the university system. And I think that you might be interested in reflecting on this as you make your remarks. In a lot of ways, I think COVID-19 is a seminal moment, not only in the history of this country, but in the history of the world. It's forced us into a surreal existence. If I had written a script 6 months ago saying that this would happen, I almost promise you it would have been rejected because it would have been too far-fetched. The fact that we now live in this kind of world where we're having this kind of conversation in a virtual format, and that this is not simply happening with us, but it's happening across the world. Some 3 billion people are now involved in lockdown, says much about how this virus has fundamentally changed our world. And the way it's changed our world is going to live with us, I believe, not only for the next couple of months or the next year or two, but for the next decade or two. And there are 3 ways that I want to touch on that I think, at least from the perspective of the university, that we are severely impacted. The first and the foremost of this is the shift to online education. What you would have seen is in the space of 2 to 3 weeks, Wits University and many other universities in this country shifted completely 100% into an online learning format. And we're now 8 weeks into that online learning format, and we're entering into our June examinations in that online learning format. And that's a fundamental shift in a very, very short space of time. And I believe that that's going to stay. I don't believe we're going to be only in online learning, and online learning is going to be the only format. But I am convinced that in the coming years, we are going to be shifting very rapidly to what we call a blended learning. A significant amount of our learning is going to be online. Another part of learning is going to be effectively face-to-face, and we're going to navigate between these 2 formats. And the reason we can't simply go online is because universities are also about face-to-face experiences. The reason, Governor, that so many people go to Harvard Business School or the Said Business School is not because they teach brilliantly in the classroom, but because of the networks you build by being there. And it seems to me that that would apply to effectively learning more generally. So that's the first fundamental shift. The second fundamental shift, it seems to me, is that it's going to transform the very character of higher education globally. What this pandemic has shown is that all of our challenges are global, whether it's climate change or renewable energy or inequality or, frankly, public health. And if we're going to resolve that, we need institutions around the world. We need universities around the world. We need human resource capacities around the world. We need hospitals. We need reserve banks. We need economic policy infrastructure. And if that's going to exist, learning has to change. We can't expect Harvard and Oxford and Cambridge to think that they're going to train the political elite, the economic elite of the world. Because if we're going to address this challenge, we need great science, great technology, and local understanding. And that means learning itself has to change. We need a partnership and a network of institutions between Harvard and Cambridge and Oxford and UCT and Makerere and Beijing and all of the Xinhua and all of the other institutions that are in the world, in a network where learning happens across the world. So that's the second fundamental shift. And the third and most relevant to your reflections, Governor, is going to be the issue of the economic policy. I think the pandemic is going to impact on our economy in significant ways. It's going to impact on our finances in government in significant ways. And that's going to have an impact for universities because it's going to impact on the subsidy and it's going to impact on the fees, because as people lose their jobs, they're not going to be able to cover the fees. And university income is made out, 92% of university income is made up from fees, and it's made up from effectively subsidy. And so getting this economy back in operation, getting employment back, ensuring that government finances are stabilized is fundamental to the stability of the university system and to how our education and human resource capacities are going to develop. And so in a sense, this pandemic has fundamentally shifted the environment for universities in significant ways. And they're not going to live with us for the next 2 to 3 months or the next 2 to 3 years. They will literally live with us for the next 1 to 2 decades. And that, it seems to me, why it's so important to have people like yourselves come to the institution and reflect on the implications of this pandemic, on monetary policy, and not only on that, on fiscal policy, but most importantly, on what those mean for getting the economy back on track in South Africa, on the continent, and around the world. So colleagues, I want to stop there. I want to thank the governor of the South African Reserve Bank for coming, making himself available on this very cold day in Gauteng to give us some reflections on monetary policy in the wake of COVID-19 and what that means for our economic and social and political future. I'll stop there. Thank you very, very much. Governor, should I invite you to come in, since our moderator is not here? So let me invite you to come in.
So you are moderating. What an honor that I will have a session facilitated by the Vice Chancellor himself. But thank you very much for the university community for inviting me to come and speak at Wits. I will say that I will observe all the protocols of all the professors that are on this virtual platform, and to all the participants, a good afternoon to all of you. It is now clear that COVID-19 outbreak will produce the worst economic downturn in a century. We expect that the great lockdown will cause output to contract by about 7% this year. The last time a figure of that magnitude appears in our data is 1931, during the Great Depression, where output fell by 6.2%. It has declined by 6.1% in 1930. The South African Reserve Bank has responded flexibly, quickly, and aggressively to this crisis. So far, these actions have improved market functioning and are supporting economic activity. However, the larger economic outlook remains uncertain. We are watching the data closely, and we are ready to act as appropriate in accordance with our mandate. Fortunately, central bank governors tend to get a lot of advice, and I have been particularly well supplied with suggestions for the South African Reserve Bank policy recently. Allow me to add to the national public debate today. I will cover 4 points. Firstly, the bond buying programs fall on a spectrum running from limited to larger interventions. Conducting any of them successfully is made possible by our inflation targeting framework and the flexible approach to take it. Secondly, the scale of asset buying we do should follow from a clear sense of why markets have been malfunctioning. I will distinguish between liquidity and sustainability problems. Central banks can provide liquidity while challenges like fiscal sustainability are best dealt with elsewhere. The third main point is that we need more clarity around the mechanics of central bank asset purchases, quantitative easing, and what is referred to as the zero lower bound. These concepts are pretty hard to understand. It is easy, for example, to take the mistaken view that quantitative easing means free money. And finally, I will reflect on the utility of inflation targeting for addressing the current economic conditions and potential depression-type conditions. The intellectual heritage of inflation targeting traces back to the study of the Great Depression. So we can say that depression fighting is in its genes. As a starting point, it is perhaps worth reviewing what we have done to date. Our 5 most important measures in response to the shock from COVID-19 have been as follows. Firstly, we have lowered interest rates. At the March meeting of the Monetary Policy Committee, we reduced the repurchase rate, the repo rate, by 100 basis points. We then held an emergency meeting in April, and we based a further rate cut on the forecasts that had been incorporated since the lockdown. In May, we cut the repo rate by a further 50 basis points. And if we go back and we include the period from January, the cumulative reduction in the repo rate for 2020 now stands at 275 basis points. To compare, the emerging market median is 100 basis points. The repo rate is now at its lowest level on record and below zero if we adjust it for inflation. We have made liquidity abundantly available to banks through a range of facilities in addition to our usual weekly repo auctions, and which take up peaking at 83 billion rands in March. And thirdly, we have provided regulatory relief to the financial sector to help maintain the flow of credit in the economy despite the temporary payment problems for firms and households caused by the COVID-19 shock. We have offered funding for small and medium enterprises starting at 100 billion rands with an option to scale up to 200 billion rands over time, or about 4% of gross domestic product. This facility is backstopped by a guarantee from the National Treasury. And fifthly, we have been buying government bonds in the secondary market to improve market functioning. The total of new purchases now stands at around 25 billion rand, which is an increase in our bond portfolio of about 0.6% of GDP from pre-crisis levels. This is comparable to purchases by emerging market peers. On these interventions, it is the last one that have prompted the most discussion, so it deserves extra attention. In responding to the COVID-19 crisis, A whole range of central banks from both advanced and emerging market economies have launched bond buying programs. These programs should be thought of as sitting on a spectrum, measured by what various central banks are trying to do. Some are buying huge quantities of assets to provide stimulus, despite the constraint of the zero lower bound. Others are conducting more limited purchases to improve market functioning. Many advanced economies sit on the far side of this spectrum. Some emerging markets like Brazil and us sit at the near end. We are aiming to improve market functioning. Recognizing this distinction, the Bank for International Settlements has referred to emerging market operations as bond purchase programs. Others have put the term QE in inverted commas to convey the nuance of the difference from ordinary QE. Sometimes I think that we should just tell people that our asset purchases were QE. Then they would stop complaining that the SARB is conservative. A criticism that has somehow survived despite surprise at how much the SARB has already done. We should not, however, simply assume that our conditions require full-blown quantitative easing, or that we can pull it off without creating unintended and damaging consequences down the road. Rather, any decision to move along the spectrum needs to be embedded in our inflation targeting framework. Getting the inflation forecast right gives us credibility to shift along the bond buying policy spectrum without tipping into higher inflation. If inflation is collapsing and existing policy measures prove not enough to bring it back to target, we can move further. Judging by the recent moderation in the long-term rate and lower inflation levels, it appears we have got overall policy effort about right for the moment. But we are in an environment of unprecedented uncertainty, and we will adjust this policy effort along that spectrum as conditions and forecasts change. When the South African Reserve Bank began intervening in the South African government bond market on the 20th of March, we had seen trading thin out, with even small transactions causing bond prices to move abruptly. By purchasing bonds in the secondary market, the South African Reserve Bank has helped restart price discovery and encourage the re-entry of private sector participants in the government bond market. We continue to monitor the government bond market, and we continue to buy bonds where we observe signs of stress at different maturities of the yield curve. We will continue as needed to restore normal market functioning. Up to now, it appears our interventions have worked. Volatility has subsided and bond yields have normalized. While we are not targeting yield specifically, the fact that the benchmark 10-year yield is back to where it was in February suggests that stress in the system has eased. We are not the only country experiencing problems in the bond market. Indeed, at the height of the crisis, even the ultra-deep and liquid United States Treasury market was disrupted, which just goes to show that in a major crisis, even the best borrowers can have liquidity problems. Solving these problems is one of the oldest duties of central banks, Such practices are literally centuries older than the term quantitative easing. The trouble is that liquidity problems are not the only factor affecting the domestic bond market. There are also problems of fiscal sustainability in the mix, which requires us to act and to communicate with caution. We need to avoid what one expert had called the mother of all sudden stops, turning into a permanent and specifically South African problem. In general, I avoid commenting on fiscal issues, but it is difficult to discuss sustainability without mentioning some fiscal facts. The most important ones are these. When COVID-19 shock hit South Africa, we were already running crisis level deficits, over 6% of GDP in 2019. Our debt stock was on a rising trajectory. Unfortunately, the coronavirus is now forcing an additional fiscal deterioration. This has resulted in South Africa losing its last investment grade rating. Market-based measures of sovereign risk, such as credit default swaps, which is a measure of the insurance that holders of South African debt pay for insuring against default, and market-based measures of sovereign, other market-based measures of sovereign risks have deteriorated further, both in absolute terms and relative to our peers. This increase in sovereign risk has in turn further raised the return on bonds asked by investors, shifting up long-term rates for the whole economy despite a low repo rate. As many economists have pointed out, sustainability concerns have to be addressed at a fiscal level. This means that the debt to GDP ratio has to stabilize, and those projections need to be realistic. If debt sustainability can be assured with high probability, then near-term borrowing will be more readily available. In these circumstances, were governments still to experience financing disruptions, we would feel confident that there were that these were liquidity problems which the SARB could help address. However, presently, sustainability is not assured, which makes large-scale sovereign bond buying potentially inflationary. The proposals on the table for more bond buying are not modest. I have seen one call for R1 trillion fiscal stimulus financed by the SARB, and another for the SARB bond purchases of between 10 and 20 billion rands per week to continue until economic recovery is well underway. These numbers imply that the SARB would be buying more or less all the new debt for the foreseeable future. Such interventions would crowd pension funds and other institutional investors out of the bond market. Worse, we would be sending a very dangerous signal. The crisis of the euro area a few years back showed how damaging it can be for countries to send mixed messages about their future monetary arrangements, the so-called redenomination risk. What this would mean for South Africa is that there would be a risk that the domestic currency will no longer be issued by a credible inflation-targeting central bank, but by one that is fully financing the public sector instead. Should we be going this way, some bondholders would probably be enthusiastic about a large bond purchase program, so they would dump their bonds on the South African Reserve Bank and minimize their losses. And why shouldn't they be looking for a way out? Imagine the situation. We would be taking over public sector financing with no clear plan for how to stop buying a potentially ever larger issuance of bonds. And although I have heard it suggested that we should do QE with conditions, we need to keep in mind that we are a national central bank. The Constitution tells me that the SAP must protect the value of the currency, and that there must be regular discussions with the Minister of Finance. Nowhere in the Constitution does it say I can set conditions for the Minister of Finance. As such, the SAP cannot take responsibility for solving a fiscal sustainability problem, nor can it jeopardize the value of the currency by agreeing to inflationary monetary money printing. Let me turn to the issue of money creation, inflation, and the sterilization of the money creation process. But why is it that monetary financing of the fiscals could be inflationary? As I have said elsewhere, I am not worried about high inflation this year, especially given the recent collapse of oil prices. But the fact that the 2020 inflation is likely to be low is in no way guarantees that inflation will stay low, and therefore that we can stop worrying about it permanently. In fact, if we commenced large-scale QE with a significant positive inflation rate, we would have to do one of two things. Either we sterilize the QE purchases by absorbing the rents bought onto our balance sheet, or we let interest rates fall below the MPC target, ultimately to zero. The problem with setting the repo rate too low is that it would generate inflation. The problem with sterilization is that it is costly. So QE proponents in South Africa have not appreciated the inescapability of this choice. And let me explain how this works in the detail. When the central bank creates money, we create one very specific type of money, which is bank reserves, also called base money. The base money system is a closed loop, which means that the central bank, as the monopoly provider of new base money, is the only institution that can change the total supply of money in the system. This is the basis for monetary policy because it confers the power to set the price of bank reserves on the central bank. When a central bank conducts a QE operation or any other kind of asset purchases, it pays in base money, which it deposits into the central bank account of the seller, whether that seller of those assets is the government or whether it is a commercial bank. This changes the total supply of bank reserves in the system. The change in supply in turn affects the price of money. The crucial implication is that unsterilized asset purchases are, in the words of two economists, tantamount to an easing of interest rate policy. As I will explain in more detail later, this is the main reason such policies can be inflationary. During this crisis, we at the SARB have already expanded the supply of central bank money. And although we have seen some deviation of short-term rates from the repo rate, these have not been too large or persistent. In practice, we have a deposit rate set at 200 basis points below the repo rate, which functions as a floor for the system. It is essentially a sterilization instrument. As predicted by theory, we have therefore seen actual short-term rates fluctuate between the repo rate and this deposit rate, although they have mostly stayed close to the repo rate. Of course, our interventions have not been going on too long, and this has been a period of severe stress in financial markets. Were we to implement a large long-term increase in bank reserves, as would be required for a big QE program, we would need to sterilize more aggressively to keep the actual overnight rate close to the repo rate. How does this sterilization work, and what techniques does the central bank use to sterilize? And this sterilization means that the money that had been injected in the system, that is excess to what is required at a particular point in time, would have to be mopped by the central bank using its techniques. One such instrument that we use is by issuing central bank debentures to soak up the rand, which basically means the central bank will borrow money from those with that excess cash in the system. Or alternatively, we could pay those banks that have got excess cash that they deposit with the central bank. We could then pay interest on that. Most of these policies would end up looking functionally equivalent to national treasury funding itself at the short end of the curve, meaning the treasury will be funding itself overnight or over a week and so forth in the money market. And in the current environment, that would mean that the treasury benefits from low rates set by monetary policy. And that is what is currently happening. And if you are a debt manager, why wouldn't you take advantage of that? Importantly, though, none of these scenarios would be a free lunch. Instead of Treasury paying interest, the cost would show up at the South African Reserve Bank as the price of doing sterilization operations. These costs would also be large. If we, as the South African Reserve Bank, were to buy, not the whole trillion that somebody thought we must buy, but we were to buy 500 billion rand of government bonds at face value, and then have to sterilize those at the repo rate, which means that that cash must be mopped up at the repo rate, because that is what everybody would be paying for bank reserves. The South African Reserve Bank would be insolvent in about a year, bankrupt. For this reason, taking the perspective of the broader public sector balance sheet, these operations would add to national treasury's already large need to borrow. How? A big QE operation wouldn't lift the budget constraint. Instead, it would end up settling the treasury with yet another bankrupt government enterprise asking for a bailout. And let me tell you, once a central bank approaches a treasury for a bailout, that is the end of the independence of a central bank. 4, we must now queue at the Treasury with all the other priorities that government has, everything from payment of social grant to the funding of education to the funding of health. And that would have come simply as a consequence of us embarking on a QE program that we end up having to sterilize, and the South African Reserve Bank would simply have its equity eroded within a period of a year. There are exceptions though. The only exception to this rule is that asset purchases entail sterilization costs if interest rates are reaching the zero lower bound. Then the sterilization costs are almost zero or negligible. This happens if even a zero interest rate is not enough to compensate a central bank's objectives like hitting an inflation target. And so economists say that you are at a zero lower bound because your interest rate actions have stopped to become effective. In this case, central banks can create enormous quantities of bank reserves which just pile up on the balance sheet without creating any further downward pressure on overnight rates. Why wouldn't it create any downward pressure on overnight rates? The reason for this is that banks with excess reserves will have no incentive to lend them out for less than zero interest. So you would be faced with a situation where banks with excess reserves would be happy to keep their money with the central bank even if that money earns zero interest. This has been the exact situation of advanced economies for much of the past decade. And it has given these central banks almost unlimited scope to buy assets. Given this extraordinary situation, one economist has described this as the age of magic money. This is not, however, the situation in most emerging markets. For us, a persistent and unsterilized increase in bank reserves would create downward pressure on interest rates. If this pressure were not released through sterilization, it would force overnight rates to zero and keep them there. This is likely to be inflationary even in a weak economy and could easily create stagflationary environments. That is a situation where you have got very weak growth or even contracting economy, and yet you have got inflation rising. Thus, creating extra reserves lowers the effective short-term interest rate compared to the repo rate set by the MPC, whether demand in the economy is weak or not. The trick, therefore, is to figure out what the appropriate short-term rate for South Africa is. Market expectations are that it will remain above 3% over the next few years. Our projections show much the same, and that this will be enough to return inflation to the 4.5% target midpoint. Even some proponents of sub-QE have acknowledged that a zero repo rate is too low for South Africa, and that it should at least be the rate ruling in the developed world plus a country risk premium. Credit and saving behavior is part of the story here, but we also need to consider the exchange rate effect in addition to the inflation expectations channel. Remember, because we have inflation several percentage points higher than in the advanced economies, our real rates can go quite a bit lower than theirs. If we really need to create extra inflation, we can set the repo rate to be -2% or -3% in inflation-adjusted terms. And then we will get inflation led by the exchange rate. This brings me to the next question, which is the role of inflation targeting during a crisis. This raises a really interesting question, however, about whether we are heading into another Great Depression, in which case such radical policies might become appropriate. There is no agreed definition of a depression, but the outstanding characteristics of the last Great Depression were large and sustained falls in both output and prices. To be clear, this is not our baseline forecast, nor is it the outlook according to all available quantitative projections. Nonetheless, we understand that we live in a highly uncertain world and that conditions could deteriorate further. It is therefore worth contemplating how the SARB would react in a depression scenario. One of the extraordinary things about the Great Depression is that our understanding of what went wrong and why has evolved dramatically over the ensuing decade. The popular contemporary view, which still features in high school accounts of the Depression, is that it was caused by a stock market crash. But the US stock market crashed many times, both before and after 1929, with much less disastrous results. Another popular explanation is that the Depression was caused by a collapse in demand, which was only ultimately resolved by active New Deal fiscal policies. But this explanation is also given secondary status by most modern scholars who emphasize instead the role of central banks. As former US Fed Chairman Ben Bernanke once said regarding the Great Depression, he said, and I quote, "We did it. We are very sorry. We won't do it again," close quote. By this account, the major mistakes were threefold. First, central banks permitted large-scale bank failures, destroying credit intermediation and contracting the money supply. Second, and largely in response to the first factor, countries fell into deflation, which pushed up the real value of debt, bankrupting borrowers. For instance, in the US, prices fell by almost 10% a year in the worst years of the Depression. Third and finally, central banks stuck to fixed exchange rate via the gold standard, which required some badly timed interest rate increases, such as the Fed's decision to raise rates by 200 basis points in October 1931. Imagine raising rates with negative inflation and real rates already in double digits. It was precisely this sort of central bank mistakes that turned sharp downturns into depressions, and then prolonged these depressions. So, when these mistakes were reversed, countries recovered. This is relevant because modern central banks, including the SARB, have policy frameworks to avoid precisely these errors. We have symmetric price stability mandates expressed in inflation targets, which tell central bankers to avoid too high and too low inflation. We have floating exchange rates, which absorb the shocks rather than magnifying them. And our accumulated credibility is now such that we can slash interest rates despite large exchange rate depreciations. We have financial stability mandates to ensure that the financial system keeps functioning under stress and that too big to fail institutions don't. In sum, far from being irrelevant in a depression scenario, our frameworks incorporate the most profound lessons of the Great Depression. If we start to go down this path, our frameworks will immediately guide us to take remedial action. This fact alone should protect us from another Great Depression. So let me draw this to a close. Frankly, rather than 1929 repeating itself, I am more worried about a different scenario. As a country, we got ourselves into a lot of trouble. We are struggling to learn the lessons of these mistakes and to achieve the consensus to fix them. We are running out of time. We have just completed our worst growth decade on record, worse than the 1980s or the 1990s. On a per capita basis, South Africans have been getting poorer since 2013. In the world, we are slipping backwards. In 1960, South African incomes were around 26% of those in the US. They are now down to 13%. They were 128% of Brazil's in 1960, a country to which we are often compared. They are now down to 65%. Rather, we risk following Argentina's path, where ideological conflicts and unstable macroeconomic policies produced a steady economic decline. In much of the period after 1994, we in South Africa surprised everyone by cooperating despite our differences and delivering robust and sustainable macroeconomic policies. But those accomplishments have faded. Instead, we now find ourselves sitting on the highest debt pile in our history, arguing about printing money and waving ideological banners at each other. It seems imperative that we work hard to define a new approach for the future. We have used up the legacy of low debt levels. Fortunately, we have achieved low inflation. We cannot squander that achievement on the quixotic belief that if we just engineer higher inflation, somehow growth will permanently rise. Our own experience shows that this belief to be wrong. And we can set out now on a new path with low interest rates if we guard and value them. We have nearly all the ingredients needed to get permanently stronger economic growth, create jobs, and rid ourselves of poverty and inequality. But we need to choose as a society to do these things. First, let's make sustainable choices that get us past the COVID-19 pandemic and help us grow in the future. We cannot, as a society, make choices today that benefits us as a generation and put the burden of dealing with those challenges on our children and our children's children. We should not allow the excesses of today's generation to put a burden on generations that follow us. Second, let us open up for investment and increase our productivity. There is no nation in the world that I know that can spend and consume itself out of its poverty. You actually need to invest, and invest, we have got to invest in capital, and we've got to invest in people. And those are the ingredients that you need to build an economy of the future that is actually productive. And finally, let us work together pragmatically to choose the reforms that will create jobs and prosperity. There are no easy answers. There is no free lunch. There are only difficult trade-offs to make in economics. In policy making, you have got to understand that there are choices that a society must make. Those choices that a society makes are going to put certain costs on different generations, and so the issue of intergenerational equity becomes even more important. And I hope that with those thoughts, as we contribute to a national public discourse, that we would have enriched the discussion that I have got no doubt will not end today. Thank you very much, Professor.
Okay. So colleagues, thank you very much, Governor. That's very, very useful. I already see a couple of questions. I just want to check whether Mzukisi is around, or does he want to take over the moderation?
Prof. Habib, if you can continue with the moderation, we'd appreciate it.
Okay, happy to do that. So let me kick off, Governor. There's a couple of questions. I'm going to give you, are you comfortable that I identify 2 or 3 and then you answer them when I go to the others?
Please.
So there's 3 questions that I've picked up immediately. I'll come to the others in a short while in a second round. The first is, will the Reserve Bank use the Forex reserves during this crisis? So that's the first question. The second is, please expand on money creation by banks through deposits. Because of the lower repo rate, this may be conducive. So could we, for instance, expand money creation by banks through deposits? And the third, if you're worried about inflation, Governor, why does the bank not purchase 20 to 30 billion per week and stop when there is inflationary impact observed? So those are the 3 questions for now, and then I'll come back to a second round as soon as you've responded.
Thank you very much, Prof. The last 2 are actually very closely related, because by its nature, inflation is a monetary phenomenon, which is why it has to be sorted out with monetary policy. As I found out earlier, that we create base money, and those who are students of economics would remember that that will be what is also called M0. And there are other definitions of money all the way up to M3, and those would include deposits and credit extended in the economy. And the whole idea of actually reducing interest rates is to actually get the bigger component of money supply, which is credit extension, to actually be going. Deposits, if if you would like to be creating deposits, dropping interest rates is exactly not how to do it. Because when you drop interest rates, you are creating a disincentive for savers. You are trying to get people to then spend the money, or they will then try to take risks. In other words, lend it to those people who are prepared to invest in something else in the hope of getting higher returns. And that is how the process works. Taken to its logical eco 101 discussion, the deposit creation. If you had deposited, if the bank takes deposits of a total of 100 rands, at some stage you will come and you will ask for your money, whether you will ask all of it or you will ask for a portion of it. But what if you arrive and you ask for your 100 rand and the bank has taken that 100 rand and it had lent it to somebody else? That creates a problem for the banks, and that's where central banks then come in. It makes the banks to put a particular percentage of their deposits as reserves with the central bank. And so those bank reserves that you have include the reserves of the banks, which is a portion of the deposits that they have. And if you want to know how quickly money is created, what is then called the money multiplier, you take that value of deposits and you divide it by the reserve ratio, and it will tell you how quickly that 100 rand repeats itself. So the money creation process then kicks on in that space, because the bank will take, the banks can't lend over, let's say the required ratio is 20%. The banks can then only lend 80 rands because the other 20 rands is with the central bank. And that process just continues over and over again. They loan the money to somebody invests or spend that money, and then they repay back with interest, and they deposit it either with that bank or another bank. And that is how, roughly how the money creation with bank deposits actually work. Inflation worries, as I had said, inflation is not our worry for the next 12 to 18 months. But that is exactly why we have decided to adjust the policy rate lower, because by adjusting the policy rate lower, it would encourage credit extension, and more importantly, it's even those who want to save might find themselves having to spend the money, because it does not make sense to be keeping money and earn the low interest rates that they would actually be in. And of course, there is another dimension. The other dimension is that many middle-class South Africans will have a loan of one form or the other, mainly a mortgage or a car loan or a credit card. And so when interest rates got cut by 275 basis points, the monthly installment on your mortgage is lower, which then leaves you with a certain amount of money which you could use either to spend, or you can use it to reduce the debt. Now, I have spelled out, the question was, then why don't you just go and buy more until inflation becomes a problem? And that is precisely the art of monetary policy. Today's inflation is not what you concern yourself about. That is in the past. What you concern yourself is, what is inflation likely to be in the future? And you set your policies to deal with what inflation is going to be in the future. And that had made central banks to invest quite a bit in modeling capacity. I have got a fairly decent sized modeling team that runs a suite of models to try and figure out where inflation is going to be in the future, where growth is going to be in the future, And based on what inflation is going to be in the future, we then set our policy settings, our repo policy settings in that manner. The last question was about the reserves, foreign exchange reserves, and whether we would use them in the current period. The point of the matter is that we use our reserves all the time. What do we use the reserves for? Government, for which we are the banker, has got daily FX needs. Government has got foreign currency denominated debt. That debt must be serviced. It must pay interest on that debt. Government has to buy, get the foreign exchange from the Reserve Bank. Secondly, government procures goods and services domestically and internationally. When it procures the goods internationally, it needs foreign exchange. That is why we hold those foreign exchange reserves. So the motive for us holding foreign exchange reserves is a precautionary one, that in an environment where you are faced with foreign exchange shortages, you can dip into those reserves when such a situation arises. We are just emerging from some 80 days of lockdown. During the lockdown, there are lots of goods that we export that we could no longer export, which meant that we could no longer earn foreign exchange. But there were also goods that we had to import for which we must pay for in foreign exchange. And amongst those goods were medical equipment and personal protection equipment. And so those must be paid for and had to be paid for in foreign exchange. And given that we might be not having enough foreign exchange to cover those imports, you could end up dipping into the foreign exchange reserve. So that's why we keep the foreign exchange reserve such that if the country needs foreign exchange to meet its foreign obligations, the central bank is there to be able to meet that. Naturally, the first point of call is the commercial banks themselves. It's when the commercial banks no longer have the foreign exchange that the central bank steps in to provide that liquidity as and when is required. Those are the three questions, Prof.
Yes, so I'm going to give you, I've noticed that there are two questions in the chat line, and then there's a question and answer section. Colleagues, I forgot that I should check there as well. Let me quickly ask the two questions, which I think are touched on, Governor. I think the first from Seppo, which is, you've spoken about the inflation rate being moderately low, your expectations in the next 18 months. What Seppo is interested in, and I'm interested in whether you'd be comfortable in forecasting, what you think will play out in the more medium to long term, the 20s and the 30s, and what the impact for the rural communities are. And Rendani suggested, while the economy is not growing, you suggested that the economy is not growing from 2013. What is suggested is what monetary and fiscal policy measures could assist in that regard. So that, it seems to me, is the second. And then the third.
Can you repeat that second question, Prof?
It's basically, you had indicated that since 2013, we have not been growing significantly. Mm-hmm. And is there any way that we could have monetary and fiscal policy measures? What are the precise measures that could assist the economy to start growing? And the third is Nangaba. Is there a prospect or hope that the repo rate will come to at least normal or acceptable normality post-COVID-19? Also, do we have a sustainable recovery post this COVID-19? And then perhaps I should ask the final question, is research by market research group Intellidex shows that the 200 billion scheme is not achieving its intended objectives with only 1% payout so far. And the big issue is that the criteria of the scheme is excluding many companies, especially small and medium enterprises owned by previously disadvantaged persons. What is the Reserve Bank doing to ensure that the scheme is relevant and accessible? So effectively, and then somebody, Gosa actually says, you will be remembered fondly, Governor, by history. So that you don't have to respond to. So if you take off with those 4 questions, that would be great.
Thank you very much. Inflation 2 to 3 years, can we have forecast that 2 to 3 years? Well, we try. Actually, even for the next 2 years, we think that inflation will remain within our target. But there are so many moving parts, and the environment is actually very uncertain. And I said to my modeling team, they are really brave putting the forecast, because now I have seen that the major central banks have resorted to putting scenarios. So they are not very comfortable to put one forecast. They put a range of forecasts and said, we're not sure which one it would be. But as I had said, though, even if without attaching any other figure other than the ones that we have posed when we said that inflation will be closer to 4.5%, that inflation is not going to be a problem over the next 12 to 18 months. And what that means, which links to the question about the repo rate normality, is that it provides space for the South African Reserve Bank to provide further accommodation should it be necessary. And may I repeat what I had always said? For those who have been craving for higher inflation leads to higher interest rates. The reason why you are having low interest rates now is because inflation is low. And for as long as inflation is contained within the target, you can continue to enjoy low interest rates. However, if some of these measures that people think we must take, and we take them irresponsibly, what you would actually have is that inflation will rise, and if inflation rises, rest assured that interest rates would be rising. That is not a scenario we are faced with, because my colleagues and I are determined that we should contain this inflation, and that by containing inflation, that enables us to provide further accommodation in as far as interest rates are concerned. And the question was raised about when would the repo return to normal? And that would necessarily entail you having to say and accept that the period after COVID-19, that normality will be what we experienced before COVID. And I doubt it would be. We are going to be under very changed economic circumstances. We're going to define a new normal. What that new normal is going to be, I do not know. And I know people are talking post-COVID, but the point here is that we might find ourselves having to live with COVID a little bit longer. Until a vaccine is found, we are going to have to learn how to live with these things and take all the precautionary measures that the health authorities are advising us to take. So I do not know what a normal repo rate would be as we come out of this crisis, because normality is going to be redefined. And this leads us then to the issue of the sustainability of the recovery. One of the measures that we have taken are temporary measures. And so the sustainability is going to be defined by what long to medium to long-term policies you put in place. And Professor, in your intro, when you talked about the blended learning, the new world of work is going to be very different. I am now talking to you from my study, and I have been operating from here for the past 3 months without having to go into the office, and I have been perfectly able to do my work. And people are going to ask the question, do I need that big office? And if people are shopping and they are shopping on their mobile phones, the question is going to come, do I have to go to the shops? And so we are going to talk about a very different economy with implications for significant parts of the current economy. And importantly, is that it's going to raise the issue about how quickly we embrace e-commerce and we move into the digital world, because that is what we are going to need to operate in an environment where we have to live with COVID. And what growth, fiscal and monetary measures? Fiscal is not where I play. It's very tempting. It's a trade that I felt very comfortable with, because that is what I applied for 15 and a half years. I still miss it, but it is now somebody's responsibility, so I do not talk about fiscal policy. In terms of monetary policy affects growth on the cycles. So if there is a shock, a short-term shock to the economy, monetary policy can provide that necessary support. The measures that I have outlined earlier, that we have taken, is exactly what monetary policy has to do to support growth after a shock. And the trick is always going to be, at what stage do we withdraw those? And you try to keep them as long as possible so that the economic recovery is sustained, and that sustainability is measured by when you see that the economy is recovering, but inflation remains within the range that, as a central bank, you have been tasked with the responsibility for. And so that is how we would talk about the sustainability. The stuff about the facility that was put by the Treasury for, you say, how does it benefit small to medium-sized enterprises? That facility is meant precisely for small to medium-sized enterprises. And the world over, everybody is learning. I can't find of any of the facilities that were put in place and there weren't adjustments based on the utilization thereof. And I would be surprised if there isn't any tweaking that takes place to this facility. But the tweaking takes place because you are getting feedback from the users of the facility. And it is also too early, by the way, to assess the takeout, because we announced this facility and the economy was under lockdown. And as the economy opens, we are seeing that the utilization of the facility does pick up. But there is no doubt that there might have to be some changes to the facility, as we have seen similar facilities around the world being tweaked to deal with particular challenges in those particular jurisdictions. Thank you.
So, Governor, I think that we've still got a couple of minutes, so I was hoping to just give you another round to answer, and then I'll conclude. This is the final round. They're really quick thoughts, if you like. There is a question that has come in on whether you're concerned that the fiscal easing by government is putting added pressure on the bank, and whether that is something of concern to you. Are you worried about the increase in the oil price? And do you think that there are certain consequences of that? The third is, are you worried about the growing debt to GDP ratio that has emerged? The fourth is, if you like, government's potential possibility of raising money on the IMF by financing on the dollar market. Are you not worried that that has a far more greater inflationary effect than monetary policy itself? And then the last two questions that are posed: could South Africa introduce solvency regulations to increase bond holdings by insurance companies? So could South Africa introduce solvency regulations to increase bond holdings by insurance companies? And then I think you answered this, but I'll give you a chance again. Is there anything you can do, suggest that we could implement for SMMEs? That SMMEs are really struggling in this market. And that's where the serious impact on employment is going to be. And is there anything substantive that we could do to assist SMMEs beyond what is currently playing out? So I'll give you a final opportunity to take those, and then we'll close this, Governor. So the floor is yours.
Thanks, Prof. Fiscal easing by government, we will know next week whether there has been fiscal easing by government. What we know is that this economy was hit by a shock. It was both a demand and a supply shock. And fiscal policy, without a doubt, would have had to respond to that shock, just as monetary policy had to respond to the shock. The shock for monetary policy was a positive one. And the positive nature of the shock for monetary policy was that this shock also came with a decline, significant decline in the oil price. And that fed into domestic price formulation. And if that is sustained and inflation remains contained, then we would say that the second round effects from the oil shock has led to lower inflation going forward. But that links to the question of the increase. Yes, there has been an increase in the oil price. We're not concerned because remember that even as the oil price has risen, it is still far lower than what it was at the beginning of the year, where we had it in the 60s. Our own oil price assumptions average for this year is just over $40 a barrel, rising to about $45, $50 a barrel next year. So we are not concerned about the oil price at the moment. Raising funding from the IMF and the dollar funding, whether it should be inflationary, no, it shouldn't be inflationary, because this is funding that you access from outside of your own country. South Africa is a savings-constrained economy. At the moment, we have got a savings ratio to GDP of around 14–15%. If the government's deficit, budget deficit, rises to some 14 or 15%, and all of that has to be borrowed in the domestic market, what that would mean is that government would borrow the entire savings of the nation, and there will be nothing left for businesses and households to borrow from. And if there is nothing left for households and businesses to borrow, because the savings rate is, the savings have been consumed by government, guess what? The borrowers are going to compete for the limited resources that are available. And when borrowers compete, the price of money goes up, which basically means that you'll end up with interest rates going up. And so government accessing foreign funding is a welcome development because it alleviates that constraint. Solvency, I think I'm not sure that I really understand that question, except to say that the prudential regulation framework that we have for the insurance companies now is called Solvency Assessment Matrix, SAM. It's also sometimes referred to as Solvency II. That prudential requirement does involve insurance companies having to look at their asset base, and amongst the asset base that they have to look at is how much do they hold in fixed income instrument bonds, and the most credit-worthy bonds in our market is government bonds, which is why they end up holding such. SMM is well, I guess this is a vehicle that had been put, and everywhere else, what happens is that specialized institutions are put in place to facilitate the funding of SMMEs. And South Africa is no exception. There isn't a shortage of this investment Kula or IDC or that are there to fund SMMEs. The question that one will always have to ask is funding the only constraint that SMMEs face? One of the things that had come during this period of the lockdown is that the big players use the SMMEs as funding. So a lot of SMMEs were complaining that their big customers were not paying them. So the big corporates, which wanted to preserve cash, decided not to pay their small to medium-sized enterprises who are their suppliers. And that puts a burden. And some of the SMMEs, they would tell you that if their suppliers were paying them, they would not be needing to go and borrow elsewhere. That said, the issue and the challenge of SMME financing is a big issue, that so much so that the Basel Committee on Banking Supervision ended up commissioning a study which is much worth reading, which had to try and understand with what are the constraints to the financing of SMMEs. Prof, thank you very much. That deals with all the questions, and I must say that what an enriching conversation. Thank you.
I wish I could, I know that I said this thing, but there is such an interesting question that has come up. And in a minute's answer, and then I promise you I will let you go. There was a question that came out about, because you've embraced e-commerce and you suggested we should embrace the digital economy, do you think cryptocurrencies pose a risk to the monetary transmission mechanism? And will SARB launch a digital currency?
Thank you very much. Crypto things are not currencies. They fancy themselves as currencies. They do not meet the definition of a currency, because a currency must meet the following three criteria. One, it must be accepted as a store of value. It must be accepted as a medium of exchange, and it must be accepted as a unit of account. And these crypto things do not qualify as currencies, in spite of them being called such. Are they assets? Yes, they are assets, which is why they have value, and they are traded and they are priced against the dollar, against this currency, and against that currency. They are there. There are very important consumer protection issues on these platforms, which people who are involved in can deal with. The SARB had explored utilizing the technology that underpins the crypto assets. And just 2 years, a year or so ago, we ran an experiment in the South African payment system space using blockchain technology. We were able to settle all the transactions that are settled in the South African payment space during the day. We were able to settle them in less than 30 minutes. And what that tells you is that the technology is of use elsewhere. We had gone out with a request for information and engaging with the service providers, exploring the possibility of a digital rand. What is called a central bank digital currency. So, truth of the matter is that many of us still talk of the rand that we have in our pocket, but the bulk of the rands are not what is circulating in paper and coin. The bulk of the rand are the ones that circulate digitally on our phones, on our computers, and so forth. And the big issue for us here is whether we move the next step and do a retail component of the digital currency. The South African rand in the wholesale market is traded digitally. You do not go and move those trillions of rands all the time. They all move digitally. And one of the things that had come out of the experience of COVID, with people scared that they should not be touching things and they do not want to touch money and all of that stuff, is that it had accelerated the efforts within the central bank community to see to what extent we can push central bank issued digital currencies.
So thank you. That brings us to a wonderful end, Governor. I do want to say a couple of thank yous. I want to say to you that there's been more than 300 people that have been part of this virtual community. And so I think it's been an incredible success. Many of the comments on the chat line have been about thanking you for taking the work. A lot of them saying you're doing an incredibly sterling job. That's something that's worth bearing in mind. There's not many public leaders that get such accolades. So congratulations on that. Many of them have actually thanked you for being willing to be part of the public discourse, which is so important in a democracy. And I want to perhaps underscore two principal comments that you make. One is the importance of nuanced conversation. Our conversation on economic policy and frankly on many things else is about in polarized conversations that are ideological. We need far more nuanced conversation in our society. And I think that that's a lesson that's well heeded. And the second is, as the current generation, we must make sure that our excesses do not become a burden for future generations. I think that that's something that is incredibly important for this generation. Don't make our challenges those of our children. Care and think about our children and do not compromise their futures by the burdens we impose on them because of our excesses today. I think those are two really powerful messages, and I think they resonate with all of us. So, Governor, I want to say thank you. I want to thank the more than 300 people that were party to this conversation. And I want to thank your office for the wonderful preparations they made in enabling this. And please, every one of you, including the governor, be safe out there. Wash your hands, make sure you're looking after yourself and keep social distance.
Thank you very much.
Thank you.